All right, so chapter 3 starts your learning about how to actually do accounting, how to do the bookkeeping cycle, how to do the accounting cycle. Chapter 3 is its own learning unit because it's a lot of work. It's a lot of work. And so please understand that even though we're only focusing on one chapter for a period of about 2 weeks, doesn't mean you need to wait any longer than today to get started, okay? Because there's a lot to learn. So what are we going to be doing in chapter 3 here? Today, we're going to be focusing on learning about how to do analysis. What are we going to analyze? We're going to analyze things that are called transactions, okay? And this is a very, very critical part of understanding accounting, is learning how to analyze transactions. So that's our focus today. That's all you got to worry about. Accounting collects lots of data. We're very picky on the type of data we collect, but we collect a lot of it. And then, of course, we process all that data. And what you get is some of the financial statements that you were working on in chapters 1 and 2. But those statements, before you can actually create them, those numbers have to come from somewhere, right? And so you're going to be learning that process here. Where do those numbers actually come from? How was the process of getting started here? So this is what we're going to be doing in this chapter. We're going to be looking at an entire accounting cycle. It's an entire year-long bookkeeping cycle. Chapter 3 focuses on the first 3 parts of that by introducing you how to analyze a transaction and then actually starting to do the accounting, which starts in something called a journal. Chapter 4 kind of wraps up the process. There's a lot of little pieces here for chapter 4 that you see. And so between chapter 3 and chapter 4, you're going to be doing the entire accounting cycle for a business for a period of a year. Okay. And then, of course, it just repeats year to year to year. But it's important to know how all these things sort of work. Okay. So today's very important lesson, I need you to put a hat on to understand how to analyze things. What do we analyze in accounting? We analyze economic events that change the financial condition of the company. If there's an economic event that changes the financial condition of the company, accounting is going to be recording that. Those are called transactions. So transactions are economic events that affect the financial condition of a company. Many business activities are transactions, but not all of them are. And that's why it's important to analyze and ask the question, is this an economic event? Is this a transaction? Or is it not? And that's part of what you're going to be learning in this chapter. Well, when I say it affects the financial condition of the company, what are we talking about? We're talking about the accounting equation, right? It affects the assets, liabilities, or stockholders' equity in a company. That's how we know it's an economic event. That's how we know it's a transaction. That when it occurred, there was a change in the financial condition of the company. How do we know that? We saw changes in some of the asset accounts or the liability accounts or the stockholders' equity accounts. And you're going to be analyzing that today as well. So just understand too that whatever is an economic event, it has something called a dual effect on the accounting equation, which means, in essence, if you want to think about it in short, it's going to affect at least 2 accounts. Sometimes there's going to be an asset account and a liability account that's affected. Sometimes it's an asset account and a stockholders' equity account that's affected. Sometimes it's 2 asset accounts that are affected. But either way, the idea of this dual system here is at least 2 accounts are going to be affected by an economic event, by a transaction. Okay, and that's what we're going to be learning how to do right now. Let's take a look at a few events. Okay, so let's first, in our first row, we purchased a computer. Now, it doesn't say how we purchased a computer, so I think we need to fill in that blank. So let's say we purchased the computer by paying cash for it. So the question then becomes, for accounting, is it a transaction? Is it a transaction? Well, if it's a transaction, that means that the financial position of the company changed, right? Well, when you purchased a computer and you used cash, did any of your assets, liabilities, or equity change for that? Yes, it did. And so we have to record that. We have to actually do accounting. Okay. Now, it's important to know, when I said the dual effect, you need to know the two accounts that it affected. So let me go back here and say we purchased the computer with cash. So if a company purchased a computer with cash, what two accounts would be affected by that transaction? Well, first thing is the obvious. You bought a computer, so you have more equipment. So equipment would certainly be impacted because you have to show your company has more equipment. Okay. And you paid cash, so that also changed the financial position of the company because you used up cash. So you also have to show that the company used cash, right? So the two accounts that would be affected specifically by that transaction, if we purchase a computer for cash, would be equipment and cash. That's the type of analysis we have to be doing here. But of course, you can buy equipment and other things. Businesses do a lot of business with other businesses, and they don't always pay cash up front. So if I'm a business and I go and buy a computer from another business, they might give me an invoice. They might give me a bill, which means that I can take the computer with me, but I'm going to need to pay them in the next 30 days. Okay. And so is that a transaction? Well, yes, it is, because the financial condition of the company has changed. Well, I have more equipment, so I have more assets, but now I have that bill to pay in 30 days. That's an accounts payable, right? So I have a change in my equipment and I have a change in my accounts payable. I have both, more equipment and more accounts payable. So this is how we have to start analyzing here. This is what you're going to be introduced to, and this is the fun part of accounting here, is all the analysis that we do. Okay, let's take a look at that second column to look at way we just discussed an option with the customer. Say Greg was interested in doing a tour. Remember, all of these transactions are based on the company that they introduced you in the book called Sierra Corporation, which does tours of the Sierra Nevada. So let's say Greg was interested in a guided tour, and he was talking about a tour and what they do on that tour and where does it go, and even the tour guide gave him a brochure of what we do, or even a business card. Question would be, is it a transaction? Did that change the financial position of the company? The answer is no, because just discussing things with customers about your products or the customer's interest in your products doesn't mean they actually bought it, right? Doesn't mean you actually sold anything. Doesn't mean any money was exchanged. Doesn't mean anything else. So no, we don't have to record that in accounting. That doesn't mean that it's not important to the business to have good customer relations and sell people a good image, but it's not a financial transaction, and so we're not going to record it. Okay. But let's stick with this and change the scenario a little bit. Let's say Greg is very interested in taking a tour. And remember, Sierra Corporation, that's what they do. They sell guided tours. And there's a tour leaving right now, and it's a $25 tour. And Greg puts up $25 and goes with the group on the tour. Is that a transaction? Answer: yes, it is. Well, why? Well, because the financial position of the company changed. How did it change? Well, the company has more cash now, because Greg gave the company $25 in cash. And the company sold Greg a tour. Now, again, what do we call it when we actually sell things? Revenue. Revenue, if you've looked at the income statement, is the source of the profit of the company. So revenue is the source of all of the profits and all the retained earnings. Right. And so that would mean that the company enriched itself by selling that tour to Greg. Right. Let's keep with this, and I'm sorry to pick on you today, Greg. Let's say Greg is very, very interested in the tour, but he can't do the tour today. He can do the tour next Tuesday, but he buys the ticket today. So he buys a $25 ticket for the tour today, but he's not going on that tour until next Tuesday. Is that a transaction? Yes, it is. What two accounts have been affected by that transaction? Well, Greg just gave me a bunch of cash, $25. So I have his cash. That's $25 cash. I have more cash. But I owe Greg a tour. Remember, knowing those accounts are very important in accounting. What's the account that shows us that we owe the customer something that they paid for already? Unearned service revenue. So it's a liability. We owe Greg a tour. It would show up as an unearned service revenue because it shows that we owe Greg a tour. Okay. So that would be how we need to start analyzing things. One more time, one other example. Greg wants to go on the tour today, but he has no money. He promises that he can pay me next time. And so I agree. I said, okay, Greg, I'll sell you the tour today. You can go on the tour today. And here's a bill.
Is that accounts receivable?
That would be my accounts receivable. That's correct. So here's a bill, and I'm going to be expecting to receive this later. So to me as a company, I have an accounts receivable, right? I'm waiting to receive money on Greg's account. But I also made a sale. I also provided a service. I took him on a tour. So that's my revenue. That's my service revenue. So this is how we have to start thinking in this part of the chapter. This is everything in accounting. The analysis is everything. The very last event here is we pay rent. So again, Sierra Corporation does tours, but they probably have a small office or shop that they have set up, and they rent that. They have a lease and they pay a monthly rent to stay there. Every time they pay that rent for the month, that is a rent expense. When you pay rent, you pay cash. You write a check, we consider that cash. So yes, it's a transaction. The condition of the company has changed. How did it change? Well, we have less cash. And rent is an expense. So we have more rent expense. What do expenses do to the profits on a company? Well, if you look at your income statement, you know what happens every time there's more and more expenses. That profit goes down. Right. So in essence, more expenses mean less profit to the company. And so your stockholders' equity is affected. Okay, because retained earnings would be smaller, okay, with less profit. So this is what we have to start doing. This is the type of thing we have to start thinking about in this part of the chapter. And it takes a little bit of practice, but I can tell you that this is how accounting is done all the way through. So this is really the time to sit and understand this stuff. Like you said, transactions affect the financial condition of the company. And we already know that the financial condition of the company can be summarized in the basic accounting equation: assets equals liabilities and stockholders' equity. The interesting thing is we have to look at stockholders' equity a little bit differently. We all right now look at stockholders' equity as simply common stock and retained earnings, when in fact retained earnings is a lot. So how much is it? Let's take a look at the slide. Again, common stockholders' equity is common stock and retained earnings, but retained earnings is a very complex account if you look at it from all those financial statements you were doing. The very first financial statement you did was the income statement, right? That was revenue minus expenses. So in essence, revenue minus expenses gives you the net income, gives you the profit of the company, right? That profit of the company, that net income, you subtract dividends from on the retained earnings statement. And then that's all dumped into retained earnings because it moves to the balance sheet. So look what we just did. We have an income statement, revenue minus expenses. That's right here. And that net income is then moved to the retained earnings statement, and we subtract out any dividends right here. And then that number is moved to the balance sheet under retained earnings. And you kind of know that now because you've seen that by doing all these financial statements. So in essence, retained earnings account on the balance sheet actually tells us, right, the story of what happened on the income statement, that transferred to the retained earnings statement, and then that balance was put on the balance sheet. So look what happens. Revenues is the source of all your profit. Okay. Selling things is the source of it. Everything starts with revenue. And so whatever the company is selling is its revenue. It's its revenue stream. Every organization has to sell something. That's the revenue stream that it has. And so that revenue stream has to be large enough to cover all the expenses and have a profit. So in essence, the profit of a company, the net income of the company, comes from the revenue. It's excess revenue because your revenue number is bigger than the expense number, and it leaves a profit. Where did that profit come from? Excess revenue. It's more revenue. So revenues are linked to more retained earnings, right? Revenues mean more profit for the company. Every time the company sells something, that's more and more profit for the company coming from that sale. The opposite is true for expenses. Every time there's expenses, the income or the profit goes down, right? So in essence, expenses take away from retained earnings because they shrink that profit. Okay? When you look at the income statement, we're subtracting out all of those expenses, and our profit's getting smaller and smaller and smaller. That's important to realize what those accounts have an effect on the overall retained earnings. Revenues increase it, expenses decrease it. Then after we have the net income, revenue minus expenses, we move it to the retained earnings statement and we take away the dividends, right? So dividends also reduce retained earnings. There's less retained earnings every time there's dividends paid because that cash is going out of the company, reducing the retained earnings. You see that on the retained earnings statement because you've been subtracting dividends from the retained earnings statement. You see that more dividends means less retained earnings. And so dividends mean less retained earnings. This is how you have to start seeing things. This particular illustration, which is both in your book and of course online, is a very important one to sort of understand when we analyze things. Okay. We have to understand revenue impacts profits. So in essence, more revenue, more retained earnings. Expenses take away from the profit. In essence, more expenses, less retained earnings. Dividends take away from retained earnings. The more dividends, the less retained earnings. Very important to understand that. Okay. So the best way to learn is by looking at a bunch of events. So your book outlines 11 different events that are happening to Sierra Corporation. Okay. And these are events that you should be studying and understanding. So Sierra Corporation is a corporation. This is how corporations begin. Once a corporation is approved, the owners need to put cash in the business. What do they get for that cash? They get shares of ownership. We call that common stock. So on October the 1st, investors put $10,000 of cash into Sierra Corporation in exchange for $10,000 of common stock. They have more ownership. And so what two accounts are affected by this transaction? Well, cash is affected. How is it affected? We have more cash. The company has more cash because the owners just put $10,000 of cash in the company, so it has more cash. But now the company has to show it has more owners. Ownership is shown as common stock. And so it has $10,000 more of common stock because that's how we show ownership in the company, through shares of common stock. How many shares? Well, we don't know, but it's $10,000 worth of shares.
What do investors actually do for a company?
They just invest. They just own.
Yeah,
They
but
don't.
they just take.
Corporations, unlike a sole proprietorship, unlike a partnership where the owners are also very likely active managers of the company. Corporations they separate management and ownership. So the owners of a corporation are not the active managers of the corporation. That's separate. So just because you have stock in McDonald's, yes, you are a shareholder, but that doesn't mean you can walk into your local McDonald's and start firing people because you don't like what's on your hamburger, because that's not your role in a corporation. In a corporation, your role is simply as an owner. You are not a manager. So to answer your question there, Greg, they separate the roles in a corporation. This book looks at things strictly from a corporate form.
Yeah, but my main question is, when a stock increases in value, does that
That
just
has nothing,
invest?
that has nothing to do with accounting. What's happening on the stock market has nothing to do with the accounting of it.
So it doesn't affect the corporation at all for the most part.
I can't say that's true. No, it will affect the company if it needs to raise more money, or things like that. But it has nothing to do with this particular transaction at all. And I'd like to focus on the accounting and not the finance. You're talking finance, which is that's my background. So I love talking about that stuff. But it takes away from the understanding of accounting. And I think that's why I want to focus on, is this a transaction? What two accounts are affected? How are they affected? Nothing else matters for our discussion today, because it's just going to confuse everyone in understanding how to analyze a
I
transaction.
just wanted to know if they were associated.
They're not.
Okay.
Yeah, they're not. So again, let's make sure that we're just focused today on analyzing a transaction, because of all these other things. There's a lot of stuff going on in the world for sure, and it's all interesting, and I love that stuff. But it takes away from learning accounting. In this case here, we have more cash. In this case here, we have more common stock. That's the purpose of this transaction. And this is how every corporation starts. You're going to see this over and over and over and over again, because this book looks at things from a corporate perspective. So once a corporation is born and the owners put cash in for common stock, you're going to see this over and over and over and over again.
Do
And
all
by the way,
corporations have it?
and by the way, this is when corporations start. They start private. They start private. So the stock exchange is public corporations, and you have to already be existing for a little while to do that. But this is all done on the private books of a company. Most corporations start private. Let's take a look at the second event here. Okay. The second event also happened on the 1st of October, and Sierra Corporation borrowed $5,000 from the bank, and they signed a note payable, 3-month, 12% note payable. So let me explain a little bit about how these loans work. Once a company has a note payable, which is in this case a short-term note payable, so it's a current liability, they get the cash up front. So on the day they get approved, they get the cash up front. They pay the whole thing back with interest on its due date. There's no monthly payments. It's not a long-term loan. Okay. They pay the whole thing back on the due date. All we care about when we analyze this event is what happened on October the 1st. On October the 1st, Sierra Corporation got $5,000 from the bank, but they also now have a loan they have to pay back in the form of a note payable. So what two accounts are affected? Well, certainly cash is affected. We have $5,000 more of cash from this transaction, but we also have $5,000 more of a note payable because we have to pay that back, obviously. So notice how the dual effect works. At least two accounts are affected by every transaction. This is the critical part to know in this part of the chapter. This is what it's all about. So event number 3 here talks about the next day, October the 2nd, where they purchased equipment by paying cash. Okay, so this is also a transaction because by buying the equipment and using cash, they changed the financial condition of the company that day. So what accounts are affected? Equipment is affected. And so how is it affected? We have more equipment. Cash is also affected. How is it affected? We have less cash. Now, I just need to make this very clear. This is not accounting. This is analysis. Okay. We're not doing accounting. We're simply doing analysis. The analysis you can't even do accounting without doing the analysis. So it's not like, oh, I can't believe he's doing it. You have to, if you don't understand this, you're not going to be able to do the accounting. So it has to start with the analysis. There's actually a lot you need to know before you can actually do accounting. So analyzing that, does it change the condition of the company? If it's a transaction, yes. What accounts are affected? So there's two accounts affected usually. And how are they affected? So in this case, equipment is affected by, we have more equipment. Cash is affected, we have less cash. So thus the plus and minus simply indicates more of something or less of something. We actually don't use pluses or minuses in real accounting, but we do in the analysis. Okay, so just understand you're learning how to analyze. You're not actually doing accounting today. Event number 4, here, Sierra Corporation on the 2nd of October, they received $1,200 in a cash advance from their client, Arnox. So, this person, Arnox, comes in, puts $1,200 cash down and says, this is an advance for future tours. Okay, so remember, this is Sierra Corporation. It's all about them. So future tours. So did that change the financial condition of the company? Yes, it did. It's a transaction. How did it do that? Well, first of all, they have $1,200 of cash that was just given to them. So they certainly have more cash. But now they owe this guy some tours. So when you owe somebody, right, it's a liability, you owe this guy some tours. So now they have $1,200 in unearned service revenue because that reminds them that they owe this client tours in the future. Okay, because that's all this person did is pay up front. The 5th event happened on the 3rd of October. Sierra Corporation got $10,000 in cash from this Copa company for guided services performed. So here they actually gave tours. When you see the word performed or any word with an ed, completed, performed, things like this, delivered, of a service company, it's that's what they do. They did work. If they did the work, it's revenue. Okay, they did the work, it's revenue. Okay, and so they have they earn $10,000 of revenue here, and of course, when you do work, only 2 ways to get paid. You get paid now, which is cash, or you wait to get paid, which is accounts receivable. All right. So in this case, they got the cash. The event number 6 on October the 3rd happened when they paid rent. They paid rent for $900. This is very common, right? Like I said, rent, as you know, is an expense. And as you know, expenses take away from the profits of the company. So in essence, less retained earnings with more expenses. So we have a $900 rent expense listed here, less retained earnings. And we pay our bills in cash because your landlord wants cash. Mm-hmm. And so we have less cash. Less cash, less retained earnings. The next event happened on the 4th of October. in which Sierra Corporation bought an insurance policy for $600. It's a 1-year insurance policy. It doesn't expire till next year. And so when anytime you buy insurance up front, particularly because all insurance policies are 6 months, a year or longer, right? It's an asset, prepaid insurance. So prepaid insurance is an asset account. You just bought $600 of that, so you have $600 more of prepaid insurance. What they didn't tell you, what's part of they assume, is you paid cash for this, and so you have less cash. Okay, which makes sense. Okay. The 8th event happened on the 5th of October, in which this company bought, so they purchased supplies, but they bought supplies on account. These two words you're going to see a lot in accounting, over and over and over again, in fact. So when you buy something, there's only 2 ways to buy something. You pay now, which means you bought it for cash. If you bought it on account, that means they gave you a bill and you got to pay it later. How much later? Within 30 days is the norm. So we call that an accounts payable. So we do have more supplies because we just bought a whole bunch of supplies. We have more supplies, $2,500 more, in fact. But we also have more bills to pay in the form of an accounts payable. The 9th event happened when Sierra Corporation hired some employees. Well, when you get hired, is it a transaction? No, there's no financial effect on the company the day you get hired, right? And you all know that because you've all had a job. And I don't think anybody here can say that as soon as they said you were hired, they cut you a check. Okay. They didn't. You had to work first, and then they paid you after you worked, right? So hiring anybody is not a transaction because the day you hire them, there's no financial event that's happening. Okay, there's certainly going to be some financial events happening in the future, but we don't do that. We don't deal with that in accounting. We only deal with happened today. Did it affect things today? No. So there's no transaction, no effect. Event number 10 happened later in the month of October when Sierra paid a dividend. So again, when you pay a dividend, a couple of things. You're always going to pay in cash. Okay, cash dividends are the most common types of dividends. And of course, when you pay a cash dividend, you have less cash because you're going to pay it. Dividends, as you know, take away from retained earnings. You know that from the retained earnings statement because you took dividends away from the retained earnings. And so dividends, in essence, lower the amount of retained earnings. Okay. The last event here shows that now that those employees have worked for you for 2 weeks, they have salaries. They have salaries, and you're going to pay them. So on the 26th of October, you paid them $4,000. Okay. So when you pay your employees, that is a salaries and wages expense. And again, expenses take away from the revenue, they take away from the profit, so they take away from retained earnings. That's why you'll see it down here showing less retained earnings. And of course, everybody here works for cash, so there's less cash. This is analysis of transactions. This is what this whole part of the chapter is all about. This is something you have to spend time on because we're going to be doing this basically for the rest of the class. And it continues in managerial accounting, it continues in other places. And so simply understand that you'll get used to it. Something like if you don't learn it today, you should quit. It's just something you're gonna see over and over and over again as you go. So the do it exercise in your book, I'm not really big on because they give you the table and they ask you what happened. I'd much rather have it the opposite. I'd much rather they told you what happened and you fill in the table. So I'm going to look at it that way because I think it's easier to understand. Again, this is a corporation. Corporations all start the same way. Investors put cash in the business for shares of stock, which we call common stock. So look at row number 1. There's more cash in the business, so we have more cash, and we have more common stock because we have more owners. That's how we show it. This is something that's going to happen every single time. This is how corporations begin on the books. Okay. The second event shows the company bought equipment, $7,000 on equipment, but they bought it on account. Remember, for a business, there's only 2 ways to buy things. You either pay cash for it, or they allow you to pay it later, which means you've got a payable, you've got a bill to pay. In this case, they got equipment, so they have more equipment for sure, but now they have a bill to pay. If it's just a general bill due in 30 days, accounts payable. The third event showed that they received $8,000 cash. Why did they get the cash? They performed services again. So when you do work, that's revenue. When you actually do the work, performed a service for a customer, that's your revenue. So you have more revenue. In this case, they paid with cash. And so you see more cash, more revenue. And the last thing here is very common. You've seen it already. Company paid rent. Rent is an expense. So when you look at it, you'll see expenses take away from retained earnings, but you also pay those bills in cash. So you'll see less cash as well. This is analysis. This is what we're going to be focused on for the next few days, because you need to understand the analysis before I can actually teach you how to do the accounting in the books. Questions?